Right now, three distinct macroeconomic pressures are actively overriding historical market trends. Tens of billions in capital are pouring into artificial intelligence. Strict new protectionist trade policies are fracturing established markets, and persistent Middle East volatility is severely restricting critical shipping lanes. Together, these forces are stripping capital from traditional Western markets and forcing a rapid global reorganization of both corporate liquidity and physical supply chains. To secure the energy and data centers required for next-generation AI, Google's parent company, Alphabet, recently triggered a massive $80 billion stock sale. This chart breaks down that $80 billion allocation. Notice the specific carve-out here. Warren Buffett's Berkshire Hathaway has already secured $10 billion of the total chunk as a cornerstone investor. At the same time, Anthropic, the startup behind the Claude foundational models, has officially filed for a U.S. initial public offering to capture even more of this aggressive generative AI capital wave. This split-screen chart compares the mild cooldown we're seeing on Wall Street against Japan's Nikkei index hitting fresh historic highs. Capital is actively flowing out of China and directly into the East Asian technology sector. The massive capital requirements for AI infrastructure are reshaping public markets, fueling record gains in East Asian tech hubs, while traditional Western equity sectors begin to cool. This global map shows 60 distinct economies facing newly proposed 12.5% U.S. import tariffs, targeting forced labor and excess capacity. In direct response, Canada requested a 16-year USMCA extension to insulate its manufacturing sectors from unpredictability in U.S. trade policy. These strict protectionist policies are also causing immediate localized distortions. A steep 15% import duty in India has made smuggled gold up to $12,000 cheaper per kilogram, triggering a massive parallel black market. The pricing divergence is so extreme that the Reserve Bank of India has had to issue public denials, rejecting international media reports that it was forced to sell off billions in foreign currency reserves to stabilize the market. These protectionist trade actions have pushed commerce into the shadows, spawning severe black market distortions that now require direct central bank intervention. This timeline tracks the 4-month Hormuz blockade, mapping sharp spikes in Brent crude, highly volatile near $100 per barrel. Simultaneously, to choke off alternative capital, the U.S. seized Iran's largest crypto exchange, escalating economic conflict during quiet peace talks. The OECD issued a grim revision to its macroeconomic forecast, warning that these prolonged shipping disruptions are acting as a sticky inflationary driver that threatens to stall post-pandemic fiscal recovery in Europe. With crude exports falling to historical lows, Saudi Arabia has officially restructured the strategy for its massive $925 billion public investment fund, completely abandoning high-profile international acquisitions in favor of local domestic infrastructure. Ongoing geopolitical friction poses a severe risk to macro stability. It is now directly forcing massive state-level funds to abandon global integration and retreat homeward to hedge their own economies. Global liquidity is no longer spreading evenly. It is rapidly concentrating into two distinct safe havens: the physical infrastructure needed for next-generation AI and heavily fortified domestic operations. Faced with strict tariff barriers and unpredictable supply chain threats, multinational corporations must pivot toward defensive, localized operations to insulate themselves from incoming volatility.